Good morning, everyone. Thank you so much for joining us this morning. My name is Evan Weiss. I'm one of the co-founders of LW Hospitality Advisors. We are a firm that focuses on valuation advisory consulting, feasibility, asset management, receivership, all within the hotel space and only within the hotel space throughout the country. We're based here in New York City. I'm actually in my office. I was just telling my co-panelists, I literally ran here because I had traffic for the first time, which we can sort of have a conversation on the call whether that's a good thing or a bad thing. But enough about me and my commute. I'd like to introduce some of my co-panelists today. First one I see on my screen is Ashish Lall. So Ashish, please tell everybody a little bit about yourself, what you do and your role, and then we'll keep rolling.
Sure. Thanks, Evan. Hi, everybody. My name is Ashish Lall. I'm a partner at Fortuna Hotels. I have a number of hotels, predominantly here in the city. Our focus is not only, owning the hotels, but also operating them from a management standpoint and developing them. Obviously it's been a trying time, and so this should be an interesting panel to say the least. I've been around for about a decade or so in Manhattan, and happy to be here and talk through the latest hospitality updates.
Thanks, Ashish. Russ?
Good morning. Russ Shattan, Executive Vice President of Acquisitions and Development for MCR. We're a New York City-based hotel owner and operator. We have 95 hotels around the country, limited service hotels like Residence Inn, Hampton Inn, and Courtyard, and then full-service hotels like the TWA Hotel at JFK Airport. We manage the New Yorker Hotel on 34th Street, and a number of others. Happy to be here. Thanks for organizing this, Evan.
Thank you, Russ. Todd.
Morning, everybody. My name is Todd Birnbaum. I'm a partner at FOC, friend of Chef. We're a boutique advisory firm that most notably advises large-scale developers across all asset classes on how to revitalize, amenitize, or curate assets, whether it be office, campus, hotel, resi. But we also work with 80 to 100 coffee roasters, restaurant groups, chefs, breweries. So we bring both sides to the equation and work from base building design straight through asset management.
Great. Thank you, Todd. Ravi.
Morning, everyone. Ravi Dave, principal at Three Wall Capital, investor in the hotel space, currently investing in the mid-scale extended stay hotels, but have invested in full service, luxury, and limited service hotels.
Thanks, everyone. Really appreciate it. And thanks for being here today. So just for all of our participants today, just so you understand, this panel is being sponsored by RISA, which is the Real Estate Service Alliance, of which I'm a member. And there's about 30 or so members throughout the city in sort of all different facets of real estate. And sort of the goal of RISA is that if someone were to come to the city and want to effectuate a transaction on whatever it may be, office, leasing, hotels, capital markets, et cetera, all those constituencies are represented within RISA. And so today, obviously, one of the biggest topics on everyone's minds has been sort of New York City. Where's hospitality? Where's it going? And all that. So Ravi, I'm going to start with you, pick on you first. Why don't you give us some of your thoughts on sort of the overall COVID effect, maybe national versus New York City? Obviously we all know that COVID's had an effect on everything. I think we've all been on enough panels to realize that, but maybe a little bit more acutely, how you think New York City is affected vis-a-vis the rest of the country from a hospitality perspective.
Well, I mean, I'd say the impact of the virus has kind of flowed with the virus. So, when New York City was kind of the hotbed in March, April, there was a complete seizure in demand in New York City. But that demand actually kind of shifted to COVID-related demand. So you kind of look at the STAR reports for April and May and see that it wasn't, it was catastrophic for sure, but it was not as catastrophic because a lot of the demand.
Okay, so
Lena?
What's going on?
No, we're good. Go ahead.
No, so a lot of the demand, whether it be National Guard, we saw in a couple of our hotels in the outer boroughs, there was a lot of traveling healthcare worker demand. So we didn't see us fall off a cliff as the market did. Now, a lot of the hotels had decided to suspend operations, you know, the big boxes, a lot of the big boxes. So we did see that, but the rest of the domestic U.S. saw impact, but they didn't see it as a shutdown. So we have hotels in North Carolina, which are near big construction sites. I mean, those hotels were continuing to hit budget because they didn't shut down construction. They didn't, you know, a lot of that IT installation, project related business wasn't shut down. I mean, in the leisure destinations, we for sure saw it. I mean, in Wilmington, North Carolina, the beaches were closed. No reason to go to Wilmington. So our hotels in that market, really, there was no activity. Then as things started opening up, we did see a healthy rebound. And as a matter of fact, in the drive to leisure destinations, I mean, the demand was greater than we had ever anticipated. And actually, in several of our hotels, we started beating our budgets.
Interesting. Russ, you folks operate one of the larger hotels in Manhattan, as well as the largest hotel at the airports, and a very interesting one at that, as well as limited select service hotels all over the country, and also the Highline Hotel in Chelsea. You know, how do you see the effect of New York City? Is it a lot worse here? Is it better? And then sort of where do you see that recovery trajectory, getting better, getting worse?
Yeah. Thank you, Evan. Good question. No, New York City is terrible. The market is devastating. There's no business travel, zero. There's no restaurants. There's no Broadway. There's no Marathon. There's no U.S. Open. There's no UN General Assembly. So all the things that make New York very special, you know, office buildings are empty. I'm sitting in mine today. I'm probably, you know, one of 20 people in a building that regularly houses 7,000. You know, the place is the city is empty. So New York hotel market is brutal. And it's going to stay that way for, you know, quite a while until business travel recovers. And every month it feels like people's offices are postponed another month. You know, people are going to start recovering, coming back to the office on Labor Day. Back in Memorial Day, everyone said we're going to go back to the office Labor Day. Labor Day is effectively tomorrow and no one's coming back. Does that mean it's now October, now November? It seems like the key word now is after January, you know, 2021. And even that might kind of bleed into, you know, later in the first quarter or, you know, later. You've heard the kind of announcements from Google and Facebook and others. So rough market. That being said, you know, sometimes the most difficult situations are those that present the best opportunities. So, you know, we're lucky that our organization is well capitalized and well positioned to take advantage of, you know, some of the carnage out there, and, you know, actively looking for great new opportunities for ourselves.
That's interesting to hear that, you know, even while you're obviously asset managing your current portfolio, which is substantial, that you're still looking for new opportunities. Are you looking for new opportunities in New York as well as throughout the country, or do you sort of look at New York as a wounded issue right now, and you know, sort of kind of wait and see? Where's sort of your trajectory on that?
Yeah, no, New York will recover. No question about that. It has after everything else. 9/11 was, you know, horrible trauma upon the city. And I'm now sitting at the World Trade Center on the 86th floor of, you know, what used to be Ground Zero. So the city recovers. It recovered after GFC. It recovered after the, you know, the horrible things that happened in the 80s. The city recovers and it builds back better and better. And, you know, there are some, you know, very deep challenges that are presented this time around. Some of the social unrest, some of the political situation, et cetera. But, you know, at least our position is that there's no reason that, you know, every time somebody says this time is different, but it isn't. So it'll be more challenging this time. But, you know, we have not given up any conviction on New York's strength and resiliency. Thanks,
Russ. Ashish, you know, you folks have a number of hotels in New York City, sort of independents and all over the spectrum, from, you know, sort of upper mid-scale, I guess, to some extent, to really, really quite nice properties that you've recently developed, the Hendricks on 38th Street, I believe. What are you guys seeing? Are you looking at any alternative uses? A lot of the questions, you know, that I constantly get from folks that are not in the hotel space is, you know, are hotels all going homeless? Is there opportunity for student housing? Is it converting to office? You know, are you seeing any of those types of opportunities at your properties?
Sure. Thanks, Evan. Yeah. So we have, to clarify, we have a number of hotels in Midtown Manhattan, to include Hotel Hendricks, which we just opened late of last year, and then 2 others in Chelsea, and then 1 in Soho, Hotel Hugo. I think, yes, we are being open to everything and anything on the revenue side. So as it relates to, we've seen a couple of hotels transition and pivot to some of that co-work office space with industrious. We saw that. We've seen a number of hotels being taken over by homeless. That's not our plan or our initiative. Ours are boutique lifestyle hotels, and I think it's tough to transition once you do that. We are seeing a number of hotels explore the student housing, given the new mandates and new availability from the government. But, where we've really kind of been focusing on week to week is on the expense side. I think lot's been said on, demand and having dropped, and, the relief workers kind of filling that gap temporarily. But, on the day-to-day side, it's really been on the expense side, where we've tried to figure out a way to run these hotels such that it's more profitable, or it's more beneficial to keep them open than to close them. A lot of hotels in New York City have closed. We've found a way to keep ours open because we found that, we've been able to become more leaner and operate these hotels. So it's just beneficial to stay open rather than close. And that's been hard, right? It's been hard because it's not just numbers on a piece of paper. And so when oftentimes people look at stats and people sit on these panels and they see it's not so much numbers on paper. You're seeing revenue drop, expenses have to kind of drop in line. It's harder in real life because these are real people you're dealing with, either through furloughs or through layoffs, or, having people take reductions in salary and actually do more roles. I think I've been really proud of our employees, and they've shown a lot of resilience, a lot of strength, because, those people that predominantly have been managers or have been directing their whole careers, 20 years, 30-year career veterans, are now cleaning rooms. They're taking front desk shifts, they're doing, 4 or 5 day, 12-hour shifts to check people in. They're also then cleaning the room when they get a free chance. They're taking on engineering responsibilities. So we've really seen our employees, since we've had such a huge reduction in employee staff, take a huge role in just the manual labor part of a hotel, which I think you'll see that in a lot of hotels, which is really unique and really a testament to the resilience of not just, these employees, but just some of the New York workers in general.
Absolutely. That's a great perspective on it. Todd, you've been waiting really patiently, chomping at the bit. And Ashish, I'm actually going to come back to you after we go to Todd about food and beverage. I know that you have a lot of involvement with that. Todd, talk to us a little bit about the food and beverage aspect. Everyone's asking, how many restaurants are going to close in New York City? Is it going to be somewhere between 30 and 50%? But I think the real question is net, how many will remain after that? So let's say even if 50% closed, there will be a certain number of restaurants that reopen and take those spaces and sort of look at it maybe as a great opportunity to, take over a restaurant where all the equipment's there and, you don't have sort of that legacy debt and those legacy receivables, right? So, where do you see F&B? What do you see as a percentage of closures? And ultimately, what do you look at as the opportunity now? I mean, I think that's really what people probably want to hear about. Where do we see the opportunity in the next 12, 18, 24, or even beyond that?
I would start by talking about how I view this as a super exciting time, actually, for reinvention. Functionally, the P&L in a New York City restaurant, and even in some of the other areas where you have significant wage pressures, it's been broken for a really long time. I mean, you're talking about, really difficult businesses, high stress businesses that are yielding less than, 10% returns. The amount of risk associated with that type of investment for that type of a return just hasn't added up for a while. And a lot of it, as I mentioned, wage pressure, but the cost of raw materials, the occupancy costs, it's all just been kind of functionally broken for a while. And what this period of time is yielding is this rethinking about service models, putting technology that was being slow to adopt into the fast lane in terms of crazy adoption rates of, payment by phone and, wireless and ordering from your chair and just all these innovations that are obvious that they need to be adopted, but we're, very, very slow. When you look at the hotel space, self-checking kiosks in the limited service model, suddenly they're everywhere. There's just so much reinvention. And then you have a lot of overthinking it also. Ultimately these restaurants are production facilities. They're making a product, and granted you have design and lighting and music, and you're giving people an experience. Ultimately you're putting out a product. I think that there's maybe been a little bit, too much that's gone into what goes into the box. Whereas now you have these second generation spaces that you've alluded to, where the capital investment for young inventors and creators, the way is paved for a whole new crop of people to come in and put interesting new product out into the market. And, the relationship between these service providers and landlords may actually shift into what I just said, service providers, because, to pour money into other people's spaces and have, that depreciate year over year, whereas your time horizon for your business to live decreases alongside that, functionally has some problems. So, what we're all about is just turning this reactive process of leasing into proactivity, where we go out and make the proper, what's the highest and best use, who's the best fit within this space, what's going to give the best overall halo effect to the ADR within a hotel or into the, the per square foot leasing or sales upstairs, and how can we effectuate change within the asset when we look at it holistically by leveraging the 5,000 square feet to make the 600 and 700,000 square feet more valuable. And I think that people right now have open minds towards thinking about how these things are structured financially, and people are just looking at the world differently, and we see open minds and clear eyes and just a path towards the future. So we're really focused. We're lucky to not be in triage mode, so we can keep our eyes towards the horizon. And I understand people that are in triage really need to just shore up existing businesses, make sure that, they can, stay in their chair and live to play another hand. But we're firmly focused on the horizon and looking at this as a huge opportunity for people.
It's interesting. So Todd, in 30 seconds, are you working on a deal right now? And if so, can you describe it without actually, if it's confidential, identifying it?
Yeah, I mean, we're under tons of NDAs. We're working on 40 deals across probably 10 cities. We have something in Charlotte opening tonight that we did during COVID.
Wow.
Put a new food service operator into Asbury Park during COVID. We relocated a bakery during COVID. We're building 3 hotels still. I mean, we lost a couple, but we're super active trying to get people reopen. We've been hired by developers to help service providers rethink their tech plan and to, figure out how are they going to survive in a post-COVID world. Bringing it back to what you were asking, yes, 30 to 40% of existing businesses, restaurants may fail in New York City, but though they were living on a float anyway, they were living on their 30 days of payables anyway. They weren't exactly living, they were surviving. And, it's terrible. I mean, I'm a former restaurant owner. I know how difficult that is. So I'm not speaking from a perspective where I don't relate to that day-to-day struggle of just keeping up. But, once again, the model was broken. And, I look at some of the people that are going to close as, breaking their chains and freeing them up to regain their quality of life and not be in that chasing tail cycle of just trying to get your, make your 30-day.
Right. That's great perspective. Ashish, I'm going to flip back to you on the food and beverage, and then we're going to head back off into the wonderful world of hotels. So we don't, so Ravi doesn't fall asleep behind his blank screen over here. Ashish, so talking about sort of reinventing the food and beverage world, I don't know how much you're able to say in a public forum, but if you can maybe kind of give us maybe a little bit about your perspective and some of the things you've been working on from the food and beverage side, again, just briefly, just to help people kind of think through things in that way.
Sure. So food and beverage is an integral part of our hotels, right? Because they may not be the glaring number on a P&L, but it's what drives people to our hotel. It's one of the main drivers to our hotels, right? So we try to build these hotels such that it's not only a beautiful product on the room side, but also has offerings so it distinguishes from some of the more cookie cutter product out there, i.e. it's got a nice full serve restaurant on the ground floor. It has a nice booming rooftop or 2 rooftops on top, one enclosed, one not enclosed. So, really brings an attraction to the hotel that you may not get from, any other hotel out there or nearby. So what we're doing, in particular is, I think on the restaurant side, we just signed a lease about a month ago with a tenant. We're trying to align ourselves more so than we have in the past with those restaurateurs. And what I mean by is, we're offering this space that's fully built out, so zero key money, right? So, the CapEx expense that a restaurateur might experience in a standalone space or a white vanilla space is taken care of them. They just have to put in their nice touches to it. Number 2 is we offer, percentage rent, at least in the short term, for these tenants, so that we align our interests with them. We understand the unpredictable nature of the climate we're in is going to make it very difficult to, withstand some of the pressures of shutting down or opening back up. So done a short term, percentage rent, and then it kind of floats into a more predictable rent feature to allow them to really, reduce their occupancy costs and make it more in line with what the revenues are. So those are kind of two kind of things. Also, we've looked at more of the delivery service model. That's something that I think restaurants are going to pivot to more and more as, they look to reduce their costs and look to, take advantage of some of these delivery platforms that are out there. So, we're making our spaces available to those restaurateurs that really want to also, deliver and make that more of a predominant business revenue standpoint or segmentation than it has been in the past. So again, a space that's fully built out that they could deliver to, because there is demand out there, and that demand has grown, even during the COVID environment, is pretty key. And then lastly is on the bar side. The bar side, we do have some spaces that are open air that are able to be open right now. And we do those spaces really well. It's because people want to be outside and people want to have a good cocktail. We've had those maintain and stay open within the certain guidelines. And I think it's been a welcome reprieve to the guys who live in the surrounding areas, because it's an outlet to go to when a lot of other places are closed. So those have been helping us carry us through this challenging time.
That's great. Thank you. Russ, we're going to shift to you. We're going to ask the multi-billion-dollar question. Unions, how in the hell do you operate a union hotel during COVID? Frankly, before COVID, but we won't go there. I'll leave you alone on that. But how does your outlook maybe differ from those that are non-union? See, Ashish, I spared you. How does your focus maybe differ? When looking at reopening hotels, operating hotels, et cetera?
Yeah. Our view on union is that it's like a non-starter to us to do a non-union hotel in New York, because you've got this kind of unquantifiable risk, sitting above your head or above your shoulders that you just have to kind of, hope that doesn't happen. And if it does happen, it comes in and your hotel flips and you had purchased it non-union or developed it on a non-union basis and it flips to union, you've obliterated your equity and, the deal is dead. So, we're proponents of kind of going in eyes wide open and, in a union environment, what you got, the IWA, the industry-wide agreement, the players, the economics, and you can just, model yourselves around that. So, that's been our approach. So our portfolio in New York City is union. It's my personal view that the city is going union across probably the entire portfolio, with the exception of some of the like commoditized, small room count products in most of the neighborhoods. But, given the political winds and some of the other sentiment in New York City, being non-union in New York is a risk. That being said, Peter Ward runs the New York Union, New York Hotel Union, Local 6, the HTC Hotel Trades Council. Peter is a very savvy businessman for his members. And, he has as much incentive as anybody on this call to, ensure that the New York City hotel economy or industry, is healthy and safe and, survives this, this horrible situation. So, we're not going to get into like the details now, but I mean, there's a lot of discussions going on in the background to kind of, figure out a way to, go forward in a union environment that works for the, the workers and works for the owners and works for the industry. And, in the next, 12 to 18 months, as the industry kind of suffers through reduced, demand and arrivals and all the other kind of, business that we rely on, there's a lot of features that allow union hotels to, to surmount the challenges. A number of our union hotels are open, some of them aren't. There'll be some that won't reopen, as this, I think one thing we've all kind of seen with this, with the COVID situation is it's really, if you were weak going into COVID, you were crushed in COVID. Who's gone bankrupt? JCPenney, Lord and Taylor, Joseph A. Bank, these were all companies that, nobody, had any much of a future before the virus struck, and, they're the ones that are gone. So, there were some New York hotels, union or non-union, that were just very poorly operated or in bad situation before kind of, this virus, hit, and then it struck them down, and some of those won't reopen. Maybe they'll reopen as office space. It was in the media this week that the Bryant Park Hotel is going to reopen as an office building, permanently shutter as a hotel. So there'll be more of that. And, that should benefit those that remain.
That was a very politically correct response, Russ. I'm proud of you.
My pleasure.
Yeah, exactly. Nobody wants to speak ill of the union anywhere, anytime in a public forum.
Well, I mean, they're our partners, and it's, I've said before, they are, and it's just, there's no benefit in going to war with them, because they're, why would you ever go to war with any of your partners? Certainly we all have differences, and we resolve them, and that's what marks, a successful hotel investment.
Well said. Well said. So it's interesting, before COVID, if any of you can remember that time, whenever we would do a valuation or an analysis, we'd constantly be asked about new supply in the markets, new supply. And a lot of folks have believed that a lot of that new supply will contract. Some of those projects will fall off. But one of our panelists today has actually opened a couple of hotels in just the last couple of months. Some people may think that he and they are crazy, but you know what? At the end of the day, when the hotels are ready to open, they're ready to open. Ravi, why don't you kind of, if you don't mind, maybe give us a little bit of perspective on opening hotels during COVID and how that changes everything from opening parties to, revenue management to planning, et cetera. I'd love to hear a little bit about that. And maybe tell us a little bit about the two hotels you guys have opened.
Yeah. So, Evan's right. We're the brave ones that open. But I mean, Ashish kind of hit it on the head in terms of, the landscape to opening, right? I mean, we looked at the crazy part is today you're not looking at, in which way do you make more money, but it's more about how do you lose less money, right? And I'd never thought, in my career I would ever say that, closed versus a pared down operation and open, how do I lose less money? But that was the analysis we did. Really, through COVID, we learned that the booking window for any demand is within the last 48 hours. So we had no idea opening yesterday, we opened a hotel in Jersey City, opening yesterday, what the demand was up until 2 days prior. We had 0 rooms on the books as of yesterday morning. This morning, we had 18 reservations yesterday. So we saw a lot. Now, some of it was related to the storms that just went through and, a lot of folks not having power at their homes, but some of it was real demand. So we wouldn't have known, but what we did is our analysis was, let's figure out how skinny the operation can get. And to Ashish's point, several of our managers are taking front desk shifts, right? They're going above and beyond what their initial job description was. And with that kind of skeleton operation, we figured it is a good time to open. A vacant box has no value, and we thought an open hotel in this environment, a brand new hotel selling the fact that no one's ever stayed in the rooms, is what we thought was a positive.
That's great. Thanks, Ravi. That's appreciated, and congrats on the opening. And truly, good luck. I built some. It's really sad, quite frankly. I was actually at the Hyatt Place in Fort Lee, New Jersey, where Ravi's family opened the property, and then the Canopy in Jersey City, and they're both gorgeous, brand new properties. And really hoping for their successes. So,
Ravi, is this the Courtesy Motel site? Did you open that yesterday?
Yep.
Hey, congratulations. That's a high-profile deal.
Thanks.
Right at the front door to the George Washington Bridge.
That's right. That's right.
Thanks, Ross.
And offline, you can talk about your memories at the Courtesy Motel. But in this, okay, got to keep this
non-union.
Non-union, very much so. Although the union members are there, interestingly. Anyway, given what's going on in New York City, I want to kind of get a little bit of a prediction. RevPAR is down plus or minus 80%. Pretty much no one's making money, like to Ravi and Ashish's point. And the question is, at this point, how do you lose less, right? I think everyone on this panel probably believes that hotels, restaurants, etc., will return. I'm curious, when do you believe they'll return to, let's say, 2019 levels? Forget about 2008 levels, but when do you think that RevPAR and EBITDA, true earnings, will return? Especially given, to Russ's point, I can't disagree with him that the city, looks to be going union, etc. So things unfortunately are getting more expensive. Property taxes are not abating anytime soon here in the city on any commercial real estate, particularly hotels. So where do you guys think the recovery is? 21, 25, 30, who knows? Todd, go. 10 seconds.
We keep thinking that Q4 of next year, things are going to start to resemble the numbers from 18, partially because we're hopeful of there actually being some defense against the virus, but also less competition may yield better results for the people who remain.
That's interesting. Ashish.
Yeah, I'm a lot more optimistic than every report I read out there. So that might just be selfish optimism, but yeah, we're looking towards middle to end of next year.
Wow. That's aggressive. I like it. I hope you're right. Do you think that food and beverage will rebound as well, sort of in the same time frame as Todd was explaining?
I think so. There's going to be a drastic reduction in supply, both on the hotel side as well as the F&B side. And again, I never bet against New York City. So, there's going to be, a ton more of demand and just not enough supply. It is unfortunate, on the landowners and the employee side, but I think those that are able to survive and have a lower leverage, capitalized balance sheet, obviously will be able to sustain and just given that those metrics between demand and supply, I think, mid to end of next year.
Wow. What about you, Russ?
Listen, nobody knows. None of us are like epidemiologists or like doctors or vaccine researchers. So, it's, you got to pick some.
Russ, behavioral psychologist. That's what this is about. This is about behavior.
It's been a change, right? Like we were all like epidemiologists in March and April, and we were all reading all the reports on what happens on virus transmission. Then we were vaccine specialists. Now we're behavioral psychologists. Okay, good one, Ravi. So I don't know. But to your point, you got to like start underwriting something. So, I think you're probably safer, later rather than sooner. I don't think the vaccine thing is going to like be a magical bullet that all of a sudden, the world's recovered to 2019, 2 weeks after everybody gets vaccinated or, the people that get vaccinated. I think it'll still there's been a lot of trauma to, the economy and to society. And I think there'll be a slow recovery. Vaccine will be the first step in, a number of kind of things that, get us back on track. But there's been wide scale job losses, huge amount of government deficit spending, all the social justice kind of disruption, which is, very worthy cause, but it'll take a little while to bring people back into kind of city center locations. So it's going to be, in our view, kind of a longer, slow recovery, but a recovery nonetheless.
I unfortunately agree with you. I think you're right. Ravi, what about you? Where's your perspective on this? Where's your underwriting looking at?
Well, I mean, it depends on the market. So you're talking about New York. I mean, the question for us is, and I forget who said it in the beginning of this call, when do these companies start getting their people to come back to the office, right? Because that's, to us, in New York City, that's the first step. Because if they're willing to let their employee come back to the office, then maybe the next step is they're ready to put them on a plane, right? Facebook telling the world, or Google telling the world, that we don't want our employees coming back and putting themselves at risk coming back to the office. I mean, they're never putting them on a plane.
Right.
Until that happens. I mean, EY, PwC, all these guys. I have a friend that works at an ad agency. She works in pharmaceuticals, and the pharmaceutical company suspended a $2 million budget for 6 people for travel. Wow. So and that's just planes, that's airlines, restaurants, and hotels. That's all it is, and Ubers, right? I mean, so to us, we have to see that. I mean, we have probably the most pessimistic view. We're looking probably, if you tell me a big box hotel in New York City, we're probably closer to 2024 for a full recovery.
So that brings up, thank you, Robbie. Appreciate that. That's good perspective. We've got about 5 minutes left. So I'd like to ask everybody here, as of today, are you buyers? And if you are a buyer, I was going to ask buyer, seller, hold, but I don't think anyone's selling today unless they have to. It's a terrible environment to be a seller, generally. Obviously, there's specific cases, but are you a buyer today of hotels in, I'll say, the New York City surrounding area, Westchester, New Jersey, et cetera? Are you a buyer? And if so, where do you believe values need to be from as it pertains to a pre-COVID level for you to be a buyer? Is it 20%? Is it 30%? Does that even matter? Is it a price per pound? Like, how are you a buyer, and and sort of what metrics are you buying on? Some folks are saying, I'm putting a 12 cap on, trailing 17, 18, 19, NOI. Or some folks are just saying, I'm buying the price per pound because I believe in the market, and long-term, how can I go wrong at $100,000 a key in Manhattan, or whatever that number is? Obviously that's too low. So I'm going to start with Ashish. What do you think?
Yeah. I think, if you're in business, right, you always want to see what's out there and what good deals are out there. So we'll be opportunistic. We always have been opportunistic. Right now we're in triage mode with all our hotels, but as deals do come around, and they will, right? I think a lot of the deals per se have been kind of shelved because of a lot of the assistance that's been given, a lot of the relaxed standards from landlords and from banks, and in doing so, it's kind of punted the ball a little bit. But we'll be opportunistic. I don't think a cap rate's the right way to do it because that'll just be a lot of noise, given unpredictable nature going forward, and understanding when actually a rebound will occur. So we'll look at a price per pound, price per key. What that price per key will be, it depends, on how nice the hotel is, where it's located. If it's in Manhattan and it's a select service, I don't know. If I'm getting something sent to me at $300,000 a key, $350 a key, yeah, I'll take a look at it.
Union or non-union?
We're opportunistic, so we'll look at whatever.
Is that a fee simple or a leasehold?
For sure, fee simple. We don't look at leaseholds.
What's your view on leaseholds, by the way, just to sort of go in a different direction? I've been seeing a lot of leaseholds that have, on hotels specifically, both union and non-union, that generally don't have any value, essentially.
Yeah, I mean, we get shown leaseholds a lot, and to date, we have not transacted on leaseholds, primarily because we think the value is in improving the land, improving the building, and providing a better experience to that customer. And so when you do that for somebody else's benefit, that just intuitively it doesn't make sense to us. So when we improve a site, improve the look and feel, we want to have that long-term residual value. We don't want to do it for on somebody, for somebody else. So we do it on our dime, and we don't do it for our own pleasure and our own benefit. So just intuitively, we don't do leaseholds.
Ravi, are you guys buyers? How are you looking at the deals, and roughly what percentage off do you think things are today if they were to sell? Or where do you need to buyer at? Where do you need the discount to be a buyer?
Well, I think Ashish is right about the cap rate, right? I mean, cash flows are so out of whack, and who knows? I mean, the way we're looking at opportunities, and we are looking at all the major markets for a number of reasons. One, we think that the reduction in supply is real, and it's going to happen in some submarkets in New York City that are going to have much greater reduction than others. And from that perspective, we think that there's going to be opportunities. I'd say it's a total basis play for us. We're looking at probably 12 to 18 months of real carry, both OpEx and, depending on what your capital structure is, carry on that, and pricing it in accordingly.
Okay. Russ?
Yeah. Well, I'll point to the LW transaction database that just came out the other day. So let's see, in Baltimore, the Renaissance Baltimore sold for $80 million, and I think that was under contract pre-COVID for $100 million. So I don't know, some guys paid, in Baltimore at a 20% discount. I don't know if they're right or wrong. I have my own opinions on Baltimore, but good for them. The Nashville deal, this Hutton sold for like $240 a room, and like across the street or down the street was the Union Station, which is under contract at like $430 a room. So, very sizable discount there. So, I don't know. Each deal is a little bit different. We're under contract on a New York hotel we're excited about. I think we're getting a good price. So,
how are you looking at buying that? Did you sort of, did you underwrite the recovery, or did you sort of look at it on a price per pound and say, we can't go wrong at this on a long-term basis? So we can't go wrong with this on a long-term basis, and we can underwrite this and hold until we make money. Is that?
Yeah, all the above.
Okay.
On the ground lease thing, ground lease is just an alternative form of financing, and it's just you're taking on more leverage. So the two famous ground lease deals in Manhattan, are both upside down. The row, all the leasehold people are all blown out. It's down to the ground lessor. 1605 Broadway, the Crown Plaza Broadway, 1607, 1605. That those guys are in trouble, and the ground lessor looks like they're going to be the pivot security. So it's a tough situation. There's a number of ground leases in New York, and there's some very, very damaged properties on ground leases. The Renaissance 57 is another famous one. So Ashish is right to kind of avoid them. We're the same.
Interesting. Todd, where do you see the recovery, and what discount, would you need to be buyers at? Where are you directing your clients? What's interesting to you?
I mean, we're looking at everything, and we're telling everybody to just keep ears open and monitor the wire for what they're hearing, especially distress. But we love the notion of using this kind of down period for reimagination and for turnaround. So if you thought an asset was underutilized or not performing prior, and we're going to do a conversion, now you don't really need to factor in this, loss of revenue by shutting down or converting in stages, to lean into this time to make some drastic changes. So when, you want to make something really, really sing, I think you're looking at a whole new pro forma when, you elevate something, from one class to another, and it's a perfect time period to kind of lean into that down period and not lose that revenue to, accomplish that.
Great perspective. I'm going to ask one last question, I think, and then we can open up for questions. I don't know exactly how to do that. Hopefully Drew or Selena can assist us with that. I see that Peter Browse, one of the recent members, has sort of made a comment, which I will address in just a moment. Legislation from the HOPE Act, CARES Act, PPP, all that kind of stuff. The HOPE Act is a new piece of legislation that's being proposed by a couple of Congress folks relating to commercial real estate, specifically potentially backing hotel debt to allow hoteliers to stay in hotels. Otherwise, throughout the country and New York City specifically, also, even with deep-pocketed investors, it looks to be that we would, probably 30 to 50% of the hotels will change hands or change ownership structures in some way, which is dramatic. And obviously in most cases, not the fault of the owner and or operator. Have you guys underwritten Hope at all, the Hope Act, or do you think there'll be another round of PPP? And if so, what do you believe that effect will be on the sort of market for hospitality, not necessarily on the operational side, but on the transactional side? Todd, we only have a few minutes here, so.
On the transactional side, I mean,
in other words, do you think it will allow people to kind of stay in their current ownership? And do you think there will be some sort of either Hope Act and or another round of PPP for business?
I mean, there will be another bailout. I mean, it's very simply, and there needs to be, but the irony being that like everyone with whom we do business that's used their PPP already, they're in a lot more trouble than the people that have just sat on it, figuring out the ground rules and figuring out how to best deploy it, which is why they need it again, because half the people have blown through it and it accomplished very, very little. It's just kind of a pass through for unemployment. So I'll be curious to see what comes out next, but I don't really have a huge opinion on it because they tend to announce these things and then make the rules afterwards. So it's just not clear to me how people will be able to use those funds.
Yeah. Russ, any perspective on that? On sort of the program, the government programs, and if that will affect transaction, either pricing or velocity?
Yeah, I mean, listen, PPP, did a lot for, a lot of people and across a lot of different industries. Some people abused it. That guy, Monty Bennett, Ashford, abused the hell out of it. He's probably going to, there was a thing in the paper that the SEC is investigating him. Maybe he goes to jail. I mean, so like, you got to be, prudent in how you kind of use these things. Some people didn't take it. Some people took too much of it. Most people probably took a responsible amount, and hopefully, as Todd said, they used it wisely. I think that, one thing that the hotel industry is looking at for the next one is the COVID liability protection. McConnell has said that that's like critical to, any deal that gets done. And I think that'll be important. Our business, is a magnet for a lot of these kind of scummy lawyers that come after us for, the ADA website lawsuits and the pool access lawsuits. I mean, there's been a lot of kind of this, this stuff that's wasn't legitimately like improving or, saving lives or improving like the experience for guests, but was just looking for kind of a big payout for special interests. So you could see this COVID liability become a big problem if it's not resolved, with legislation. So that'll be important. There'll definitely be another round of, some kind of stimulus. It's, I think, too soon for any of us to tell on what form it takes.
Okay. Ravi?
Yeah. I mean, I say the same thing. And to Todd's point, the PPP, we were, all owners, operators, employers were meant to be unemployment insurance for their employees. So when we received it, I mean, we took it and we utilized 100% of it for payroll and benefits, PTB.
Right. Yeah. Actually, there's a bunch of questions here. The first one refers to, as I mentioned a moment ago, Bryant Park Hotel converting to office doesn't really solve a problem. I think it's more of a comment, actually. There's just also too much office space. And that's from Peter Browse, who's one of the principals with Lee & Associates here in the city. So, Peter, I mean, I think that's probably a very acute comment. And frankly, it's a lot of shifts in office, right? We see, on one hand, we see Facebook taking 730,000 square feet right next to Penn Station at the Farley Post Office. On the other hand, I read this morning on The Real Deal about, Condé Nast looking to jettison some of their space down on One World Trade, move back to Midtown. What does that mean for downtown? There's a lot of questions remaining. Wayne Bellett actually has a question, which is a really interesting one, also a member of RISA. What effect will congestion pricing have on hotels below 60th Street, if any? Anybody have any thoughts on that? Ashish, do you have any sort of perspective on that? I personally don't. I personally don't think it'll have too much of an effect, just for the mere fact that most hotel guests are not driving. They're taking Ubers or public transportation when it's safe again. So I don't believe it'll affect hotels very much. Ashish, what do you think?
Yeah, I mean, it's not something that's come to my mind as of late, given everything else going on. So I don't think it's going to have a huge impact, truthfully. Um, there's a lot of other things that have an impact versus that.
I don't know. I just got my first speeding ticket in Manhattan. I didn't know that there was speed cameras in Manhattan now. I was going in Manhattan. I have seen there's a lot in the outer boroughs, and there's one on Queens Boulevard that's caught me before on the way out to the airport. But on Madison and 93rd Street, I was going 31 miles per hour, which is 6 miles per hour over the 25-mile-per-hour speed limit. There's a 5-mile-per-hour grace period. So you're okay at 30, but you're not okay at 31. Camera took my license plate and sent me a ticket. I just opened it last night. That's ridiculous. I wasn't happy about that. I mean, the city shouldn't be like, at 31 miles per hour on Madison Avenue, a major street, like the city shouldn't be, taxing dollars and cents, nickel and diming people like that, in this environment. So, maybe the congestion pricing is a similar sentiment. When the city was full a year and a half ago and, the economy was booming, there was opportunity to kind of, eke out some more money from the commuters, but, we're in a different environment now, and maybe that should be suspended a little longer.
Evan, I don't see that correlation between the congestion pricing, but between your comment about hitting traffic this morning and then congestion pricing and speed cameras and just the overall discussion of people returning to work in the city. I mean, I'm someone who rides the rail and commutes, but I've been driving into the city for work a couple of days a week these past few months, parking illegally, haven't gotten a ticket. And until they get people out of their cars and back onto mass transit, you won't see that office return. Now, I'm somebody with antibodies who already had COVID and thank God had a mild case and recovered. And there's no reason that I have this fear of riding the rails. And all it's going to take is for them to force me onto that train once for me to break down that barrier. And they're, now with the checkpoints for quarantine that they're going to be putting at the at tolls and at bridges and tunnels that they discussed in the news yesterday, plus the fact that I just learned I can't go more than 30 miles per hour, plus the fact that as do return a little bit to work, we're going to all hit a crazy amount of traffic. It's going to force people back onto those trains. And I think once that happens, it'll reestablish a rhythm pretty quickly. But we just simply don't have enough parking spaces in New York City to handle the way people are thinking about commuting in the near future. I think
the trains are nice now. They close them at night. They clean them.
Clean and safe. Yeah.
The homeless are living in our hotels. I mean, the trains it's a whole better experience. So, I think we're all hitting on a bigger issue is quality of life. Is the city, is going to have to kind of work hard to bring people back, establish that it's safe and healthy and comfortable. And little things like a 31 mile per hour, speeding ticket and the congestion pricing, letting people kind of, off the hook on illegal parking. That's, those are like real dollars and cents for people, it improves basic elements of quality of life. And if, maybe the next mayor will be more cognizant to that and, help the business community be more, welcoming to people who want to come and spend their money in New York City.
I definitely do not want to comment on the mayor because then they'll have to start bleeping me with all the expletives. But one last question from Michael Feldman, another recent member. Were hotel and this is probably most opportune for Ashish, Russ, or Ravi. Were hotel operating companies eligible for PPP? And if so, do you have a sense of how much this helped keep the operators themselves afloat? And what about the hotel ownership entities? Did they get PPP as well? So I guess operating and ownership entities and how much was it assistive in keeping doors open?
Yeah, it's a good question. There was a lot of certain banks interpreted it differently. Sometimes the applicant was the management company. Sometimes the applicant was the owner. In the hotel business, obviously the manager employs the personnel, the employees, but the employees are paid for by the property owner. So there was kind of a different of opinion. We applied. We are owner and operator, so we applied from our operations arm. But we know others who are owners who made the application as opposed to the management companies they've hired. And I think everybody was funded one way or the other. So in the end, it didn't, there was a lot of talk about it. Certain banks said we want to see it as the owner, certain banks said we want to see it as the operator. But in the end, everybody, I think, received their loans without a lot of like red tape on that front. To the extent that it was helpful, yeah, sure.
It'll be curious to see about forgiveness when that side of it comes out. Exactly.
Well, they've pushed that back, which has been helpful too. I mean, they were revising PPP up until like, every, twice a week there for about, 3 months. And it kept getting, it initially was very generous, and then they kind of rolled it back and back and back. But then they made some positive moves. They pushed back the threshold by which you measure the rehired personnel, which will make the loans, better probability to be more forgivable.
Well, we are coming up on 10 o'clock here. I want to give a tremendous thank you to all of our panelists, Ashish, Todd, Ravi, and Russ. Really, thank you guys so much for preparing for this. As I mentioned on our pre-call, I think we only got to about 6 out of 15 questions, so we'll have to do this again sometime. Also, tremendous thanks to Drew with Lane Associates. Thank you so much for helping us out, and to Selena here at LW. Really appreciate you folks handling the back-end operations to this. Thank you, everyone. We really appreciate your time for listening. And again, thank you to the panelists. Have a great day, and let's all go be successful. Thank you.
Thanks, Evan.
Thanks, guys.
Thanks, Evan.
See ya.